Good day to all my fellow investors. Today we are going to take a closer look at a dividend gem in a period of economic and geopolitical uncertainty. It is a healthcare stock and it is indeed Merck. They have continued to actively increase their share in the treatment of oncological and cardiovascular diseases. In addition to expanding the company's product portfolio, Merck's revenue and operating income also show a significant increase compared to the previous year. And if we look at the chart year to date, we can see that it's right now trading at $85. Year to date, it's up 11.67%, quite nice compared to the market in general. And if we look back 1 year, it's 17% up. So it could be that it is a bit overvalued right now, but let's take a closer look at that. First, we will look at some of the fundamentals of the company and then use our 5 valuation model, the Graham-Weiss valuation, discounted cash flow model, the dividend discount model, the multiples valuation, and the free cash flow valuation to get an idea whether or not the stock is over or undervalued. If you want to get these for yourself, then you can follow the link to my Patreon in the description below. Right now, Merck is trading at a PE non-GAAP forward ratio of 11.62, and if we compare that to the 5-year average at 14.38, it's almost 20% below, so that could actually indicate that there is some discount to be had at the present time. If we look at the dividend, they are really looking good, I would say. Dividend yield of 3.22, payout ratio well below that 60% mark. I like to have it below that 35%, 5-year growth rate of 9%, and the dividend has been grown for 11 consecutive years. If we look at some of the numbers behind, as mentioned, this revenue has gone up from December 17 at $40 billion to December 21 at $48 billion, and for the last 12 months, $57 billion. And if we go down, you can also see that net income is exploding from 2.3 million in 17 up to 13 in December 21, and for the last 12 months, 16.5. So they are really generating a lot of revenue. Jumping into the cash flow statement, you can see the cash from operations are also looking really good, I would say. 6.5 million in December 17 up to 14 billion in December 21, and for the last 12 months, $18.8 billion. And the capital expenditures are actually kept pretty okay. 1.8, 2.6, 3.3, 4.4, 4.4, 4.4. They are using a lot of money for cash acquisitions, as you can see here. 12 billion in December 21. 6 billion the year before, and 5 billion. So they are using a lot of money to actually grow their business, which is really nice to see as well. So if we jump into the balance sheet, even though they are using that much money on acquisitions, they do have a total cash and short-term investment balance of $10 billion. And if we scroll down here to the bottom of the sheet, you can see the total debt is 31. So they can actually pay off right now, if they wanted, $10 billion of the debt, and they will have 21 billion left, which is a pretty good ratio, I would say. So they are definitely keeping their debt well governed. Also nice to see in the total shares outstanding that they have been decreasing over the last 5 years. They have been issuing a small amount of shares since the last report, but maybe due to something with the acquisitions or anything, I'm not really sure. So that is definitely something you need to look into. That was how some of the numbers behind look, but let's take a closer look at the intrinsic value to get an idea whether or not the stock is over or undervalued. And it's important not to skip ahead in this part, as I will share the assumptions I'm making for my valuation. As mentioned earlier, this stock screener is available via my Patreon, so just follow the link in the description if you would like to have it. So the first one up here is the Graham-Weiss valuation model, and as you can see here, I've just plugged in MRK as a stock taker, and I've used a growth rate of 10.8, which is in line with the earnings calls that the company have made, I would say. I also put in the current rate of AAA corporate bonds. These might rise in the future, so this is here and now, I would say. And the intrinsic value it puts out is $125. The next model is the discounted cash flow model, and as you can see here, we have the free cash flow from the different years, the last 10 years. I've applied a growth rate of 10%, even though the average growth rate is 18. They are masters of generating cash flow, and in healthcare their margins are pretty high, so I've no doubt that 10% is maybe on the bit conservative side, but also we are going into a recession possibly, and we don't really know what's ahead, so I feel that this is a pretty conservative bet. So what happens in the discounted cash flow model? We take the cash flow they are generating and then we put it into the future using our applied growth rate. We then discount it back to present value, add it all together, add the cash they have on hand and the total debt, and it gives us the equity value divided by the shares outstanding. It gives us a fair value of $77 per share. If we jump into the dividend discount model, we take a look at the previous dividends and then we combine it back using the weighted average cost of capital to give an intrinsic value, and in this case it calculates the intrinsic value to $124. Jumping into the next one, which is the multiples valuation, we compare it to companies that are very similar, their EPS and their multiples, and then it gives us a stock price of $105 for Merck. Jumping into the last valuation model, which is the free cash flow valuation, and the way that works is that it takes the price to free cash flow ratio over the last 10 years, we average all of them together, we combine it with the free cash flow per share, and that gives us an intrinsic value of $129. Before we get into the summary, if you have come so far, thank you so much for watching this video, and please like the video and subscribe to support the channel. Let's jump into the summary. So what we do have here is our 5 valuation models summed up. It gives us the average intrinsic value, which is $112. If we compare that to the current price of $87, there's already an average current discount of $22. We can then apply a margin of safety of, let's say, 20%, and that gives us an acceptable buy price of $90. So this model would indicate that with a margin of safety that Merck is a pretty good buy at the current time. So the next step here is to go do more research if you are interested in the company. So let me know down in the comments if this is a company you are interested in, or maybe you're already holding it. And if not, I'd love to hear as well. Thanks once again for watching.